In this video we will discuss about inventory valuation.
What is inventory valuation?
Inventory valuation is an accounting practice that is followed by companies to find out the value of unsold inventory stock at the time they are preparing their financial statements. Inventory stock is an asset for an organization, and to record it in the balance sheet, it needs to have a financial value. This value can help you determine your inventory turnover ratio, which in turn will help you to plan your purchasing decisions.
Why is inventory valuation important?
Identifying the unsold items is just one step in inventory valuation. You also need a rate that you can multiply by the quantity to arrive at a final value. You may have paid different prices for these items throughout the year, so you need to choose a technique to calculate a common rate.
What are the different inventory valuation methods?
There are 3 methods for inventory valuation: FIFO, first in, first out; LIFO, last in, first out; and WAC, weighted average cost. 1. In FIFO, you assume that the first items purchased are the first to leave the warehouse. In other words, whenever you make a sale under FIFO, the items will be subtracted from the first list of products which entered your store or warehouse. 2. In LIFO, you make the opposite assumption, that the last items that enter your store are the first ones to leave. 3. The WAC method uses the item's average cost throughout the year. The average cost per unit is calculated by dividing the total cost by the total number of units purchased during the year. Nowadays the most common method used is WAC, weighted average cost, but in restaurants and fast food business FIFO is used. The concept of inventory valuation can seem a little heavy at first. However, once we break it down and demonstrate each technique, it gets a lot simpler. If you got slightly overwhelmed, though, here's a quick recap of what you need to know. 1. Inventory valuation is the monetary value of your unsold stock. 2. You need to choose an inventory valuation technique because the price you pay for items from your vendor might change throughout the year. 3. There are 3 techniques of inventory valuation: FIFO, first in, first out; LIFO, last in, first out; and WAC, weighted average cost. 4. Choosing an inventory valuation technique depends a lot on your financial goals and market conditions. Just don't change valuation techniques too often, because it can complicate your bookkeeping and raise suspicions. Whether you're an established business owner or a newbie entrepreneur, you need to know about inventory valuation, because inventory plays a big part in the asset category of your balance sheet. An understanding of inventory valuation and its importance can help you meet your business growth goals and make the best of current market conditions.